Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cashflow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Let's start. As I've said the last couple of Wednesdays, not more than 5 or 6 minutes on Exhibits A, B, and C. I would say the change on Exhibit C, world oil supply and demand, from last Wednesday could turn out to be significant because I thought that the price of oil in the near month of around $90 and $80 for the rest of this year and $75 12 months out had built into it the probability, say a 50% probability, that the straits, Hormuz, where the 20 million barrels coming through the straits pre-war, was going to be mostly lost to the market. And I think I've consistently taken that position since the first bombs flew at the beginning of March. That may not be true. I admire enormously consistency, but at times you have to take into account change. And I think the change is that the United States, as continuing the embargo as number one alternative. Number two alternative would be to resume bombs and missiles and whatnot on Iranian facilities. Number three would be to take some of the Marines and airborne troops and start to do some type of land operation. I think alternatives 2 and 3 have pretty much been ruled out by the president and his advisors. And I think the reason is just it's so politically unpopular in the U.S. I mean, $4 gasoline's unpopular. Part of Trump's mandate when he ran for office was no more forever wars. So the alternative to continuing the embargo is to take a weaker than ideal from the Iranians on uranium enrichment. They apparently have offered not enrich for 5 years, and then after 5 years to enrich just for the amount they need for fuel for their nuclear plant and for medical purposes or whatever research purposes. But they'd be free to. It'd be a 10-year commitment. They take their equipment, their fuel, which had been upgraded to 60%, to the extent it's buried underground, somehow recover it and ship it to Russia, with Russia diluting it and shipping half of it back in diluted form to use in their, for their commercial uses. That to me doesn't seem like too bad a deal for the U.S. to agree to, but apparently we're not going to. So I think the embargo goes on indefinitely. Within Iran, the elected government, their parliament and their president are being overruled by the head of the guards. And so it's not even clear that agreement on enrichment has been sanctioned by the head of the guards. As Trump has complained, it's a little unclear who has the authority to agree to what. So now the Iranians say that they won't get into serious negotiations until we lift the embargo. And they say that if we have the embargo on, nothing else is going to pass through the straits. So, and they seem to be able to enforce that with their most of their Navy has been sunk, 100 ships or something, but they have these speedboats with rocket launchers and grenade launchers and machine guns. And that seems to be more than enough to stop ships. So we're at an impasse. Now, as it's become clear in the days since last Wednesday that we're on an impasse, the near month is now trading up a full $10, like 105 rather than 95. The curve won't go up quite as much. So what now will the people who need the oil do? I mean, the physical price for oil has been trading a significant premium over the index prices, whether it be Brent or WTI. So I think we're in a little bit uncharted waters. So I think prices will be somewhat higher. If we turn to Exhibit B, the impact of these somewhat higher oil prices is going to be somewhat lower gas prices. And you can see that. I mean, last Thursday, the near month was 261. The 26 price for gas was 350, and the 27 price was 395. I think the trend in those prices is going to be down because I mention this almost every Wednesday, but if you look at the second paragraph there, the increase in dry gas supply over the last 4 years has been primarily from the Permian. The Permian is associated gas, and the more oil activity there is out there, the more gas. And at the hub where this gas trades, it's been consistently in negative territory. In fact, most of the recent days in the last 2 or 3 weeks, if you've had gas that you didn't have transportation for to get it to the Gulf Coast or get it out to Arizona and California, you had to pay like $4 on average to handle the gas. So that obviously very negative for gas in Waha. Now there is more pipe capacity coming on to move that gas to the Gulf Coast. But I think that overall is gonna, the stronger the near-term oil price is, I think the worse it is for gas supply. Oil, the near month, I was kind of proud of the way the industry was behaving, that it was finding ways to move products around and do some substitution and keep Brent kind of in the $90 range. But I'm not sure the industry is resilient enough to do that. So I think as it impacts other investments, the stock market as it all, or debt markets or political races or whatnot, I think we should be prepared for seeing in the near month numbers in the 110, 115, 120 range. I don't really think in terms of the impact on our economy or on China's economy, the 2 largest economies in the world, or most of the other large economies, Japan, Germany, two other large economies. I think the economies are resilient enough, so I don't think these very high near-month oil prices will have too much impact. But it's certainly not a positive in terms of economic activity. And amongst other things, there's going to be much larger sales on a worldwide basis of EVs. And so, does it starting to trade in the 115, 120 range on the near month make a difference being squared to 90? I wouldn't think so, but it is in this impasse going to trade higher than where we have been trading. I won't say anything about Exhibit A, that cash flow statement for the federal government, except that I do believe there's a good chance that healthcare costs for Medicare and Medicaid will flatten, 26 versus 25, and again, 27 versus 26. I think the all other category, some of it was that effort made at Doge, which was very unpopular, made Musk very unpopular. I do think it'll have some benefit. But the Trump administration is going to want larger defense spending. I don't know how much of that they'll get. They're asking for $1.5 trillion, which would be up from 900 and some odd billion or whatever it is this fiscal year. I think they'll get an extra 100 billion or 150 billion, but I think the more important thing for the administration to do is to spend that money more efficiently. And Hegseth, the Secretary of Defense, no one seems to have much good to say about Hegseth. There certainly has been a lot of turnover. The highest ranking Army officer was retired. The Secretary of the Navy was retired, was fired. There certainly is a lot of changing of the ranks in the Defense Department. I don't know. I don't want to defend that. However, I do think that making our government more efficient, getting more value out of our defense spending is very, very important. For example, the reason we can't clear the straits is drones that cost $30,000 each, and we don't have for the Navy ships or for that matter, trying to help the Gulf Arabs fend off the drones as well as the missiles. We don't really have good anti-drone systems. Well, this is a failure of the defense establishment in our country and probably in Europe as well. If you follow the Ukraine war, drones have changed everything there. So I think shaking up the ranks in the Defense Department is important. I'm hopeful that since we really can't run, we have to get our deficit, to manage our deficit so it's lower. I'm hoping that the restructured defense effort can get more efficiency, more usefulness out of defense spending, and that we still have a downward trajectory on Mike, Jason, now I said 6 minutes and now it's 14 minutes, but anything more?
Well, I'm an optimist, and on defense spending, I feel like there's a handful of really innovative startup defense tech companies that are more product focused instead of billing the government for large scale, long-term programs. Palantir was kind of the first one that kind of pushed this on the software side, at least, that we're going to build a product and sell that to the government and to the Defense Department rather than go through the traditional RFP contracting process. So I have hope that they're going to displace the existing defense contractors and be a much more cost-effective way for us to procure weapons and defense tools and all that kind of equipment. That said, the 5 or 6 prime defense contractors have huge lobby arms, and they're not going to want to be displaced. So I think it'll be a process. If we can do that, I think there's a lot of hope for bringing those costs down.
That's coming from someone who worked in that area for fair part of his commercial life.
Yeah, the incentive there is it's kind of like healthcare. It's you want to take more time and bill more hours. Cost overruns mean you make more profit.
And the excuse has always been, well, that's what the client asked for. And that's the difference in the approach that the new companies are taking. They're building the product first rather than taking the requirements from the customer. Because taking the requirements from the customer is how you end up with the F-35 program that costs a ridiculous amount of money. You have the LC program, which has pretty well understood failure in government contracting.
Yeah. Well, a part of that's leadership. When you decide you're going to build an F-35 that you're going to spend a tremendous amount of money on, you're going to try to please everyone, every branch of the military, and then you end up with something that isn't excellent for anyone, but good enough maybe for all of them.
Mm-hmm. Yeah.
And it's too expensive.
It's been a while since we've added new companies, but if you get your 20-page memo, the 427 draft, you'll see Palantir added in on the Netflix page. Not that it bears any particular relation to Netflix or Disney or Meta or Spotify, but it happened to be a page that only had 4, so we could add a 5th. Another company added last weekend was Micron. As a lot of you know, the memory chip companies had an incredible year last year as it became clear that data centers were going to need more memory. And, Micron is a U.S. company. It does have operations in China and whatnot. But, it's, especially with the cash that built up in their business last year, their sales doubled and whatnot. But significant size. You look at page 6, it's free cash flow is $40 million. So it's in on a page with AT&T and Verizon, T-Mobile, but I apologize for that. But we have, we don't want to be more than 20 pages. So when we have these new interesting companies, we'll fit them in wherever we can. With that, we've been covering companies and their positions. I guess the word which is used too much is moats. In other words, what kind of position do they have against their competitors, or how disruptive could their business plans be? Unless Mike or Jason may want to correct me, but I think we did Lilly, I think we did NVIDIA, we did Microsoft, we did Apple, and I think the schedule for this week is to do Amazon. But not only cover Amazon, half of Amazon is delivering packages, which we all get, all those cardboard boxes. But and the other half, of course, is AWS and some other products. But I think what we're going to cover today is the retail part, the getting same day delivery, or in many markets 3-hour delivery or 4-hour delivery. And I don't think Mike and Jason were particularly intrigued with the idea. I thought, though, that if we're going to talk that part of Amazon or all of Amazon, and Amazon, of course, is on page 1, we also ought to talk about Walmart, which is on page 8. Now, both of them sell a lot of stuff. We're in a $31 trillion economy. Amazon's sales are around $700 billion. And interestingly enough, the Walmart sales are around $700 billion. So those are pretty big chunks in a $31 trillion economy. Walmart has had a pretty good last couple of years and deploying a lot of technology and really trying to compete with Amazon. It's hard, I think, to be Target, say, for example, and try to compete with them. I think it's hard for anyone to compete with Amazon or Walmart. But Mike and Jason, before we move on to the other parts of Amazon, any commentary on how these two companies are going to progress this year, next year, the year after, or how it seems to me that it's going to be pretty hard for anyone to be disruptive with them, just all the amount that they've invested in their infrastructure. Walmart with their warehouses and all their technology in their warehouses and their stores and so forth, and then Amazon with, once again, warehouses and all kinds of logistics to get things, to have delivery in a few hours rather than just the next day. I don't see how these people. I don't want to say that they can't be disrupted, but it just seems to me that both of them, from a management point of view and kind of smart capital spenders point of view, have put themselves in a really strong position to continue to pick up market share in terms of serving all of us as consumers. Or where's the crack in their program? In other words, where might they have a problem competing, or who might be able to be successful competing against them?
If you're going to look at big retail, the three companies that I think you want to look at is Amazon, Walmart, and Costco. So how has Walmart maintained relevancy? Remember when Walmart had a very distinct approach, and it was very much built on logistics and having these stores that were within a 10-minute drive of some high percentage of the population, something like 90% or something like that, maybe it's 70%. Either way, they have this huge reach, and replicating that is very, very difficult. It would be foolish for anyone to try to do exactly what Walmart has done. Costco, on the other hand, is focused on essentially a different tier of consumer, a higher end tier. and delivering this scale economies shared value proposition to the customer. So the larger that Costco gets, the more maybe negotiating leverage they have against their suppliers, and they deliver that through in a fixed price markup, which, again, with them, they have a membership fee, something that Amazon adopted later in life. Amazon comes with a completely different approach. Initially, just providing access to the long tail of products that you couldn't get at those stores. These are the early .com days, initially delivered by the U.S. Postal Service or UPS. And what's happened with their business model that's changed dramatically over the last, call it 5-6 years, is they've gone from delivery timelines of 4 or 5 days to a week to now as little as an hour in many major cities. So these companies aren't necessarily competing head to head, but they're increasingly competing for the same customer. Walmart has pretty clearly gone up market quite a bit. Costco, we saw a huge increase in impressively post like 22, 23, people shifted their purchasing patterns to go more towards Costco. And if you look at what's happened over the past 2 years, like Hunt said, Walmart's done incredibly well. And it shows in their PE ratio. The PE ratio has moved from low 20s to mid 40s. Costco has a PE ratio of 47. Amazon, for the first time in Amazon's life, the 12-month PE ratio for the last just over a year is actually lower than that of Walmart. So what's happening here? I think Amazon is playing per usual, is playing the very long game. They basically accept zero margin on retail, and they monetize through advertising on that chunk of the business. The other two players, Costco and Walmart, both make money on markups. I think Walmart's gross margin averages about 35%, if I remember right, and Costco's might be a little lower. And maybe over the long term, there's room here, but I think inevitably these three will be forced to compete because at some point the market you're serving starts to bump into the market that the other group is serving. And Walmart certainly made some of those moves already. They've drastically improved their direct-to-home delivery programs. They got into grocery years ago. So I think it's inevitable that this market becomes more competitive. And then the question is, which one do you want to own, if you want to own any of them?
Well, at the price you have to pay today to own them, certainly Walmart and Costco look expensive, and Amazon does not. And maybe that's because of the data center and the more tech side of it reasons. But yeah, I think they're already competing. One of the initiatives you hear from Amazon is if they're trying to sell smaller quantities of goods, they probably lose money when they sell you very low value items. If the economy starts to falter, you're going to buy 1 tube of toothpaste because you need it now instead of 4 or 8 tubes from Costco or Amazon because that's how they did it. But Amazon's going to start shipping single tubes of toothpaste, for instance, and they claim they want to do that profitably. So they've invested a tremendous amount in their logistics network. Yeah, Walmart services everyone with a store within 10 miles. Amazon's going to bring the goods to you anywhere in the country in hours. And they've built a logistics business bigger than UPS at this point. So I think they're monetizing that as well through the third-party services.
Yeah, I think that's what's interesting is Walmart was initially basically a logistics business, and Amazon retail was initially a tech business, and Amazon has easily moved into and surpassed on the logistics side, and that's not really reflective in the valuation. So Walmart's worth about $1 trillion is the enterprise value. What percent of Amazon's valuation accounts for the retail business? I don't think it's very much. Certainly not $1 trillion.
Costco is over on page 17. Costco's market cap, they have no debt. Their market cap's 400 million or so, 440 million. Remarkable company and remarkable record, but a little flat recently. If I had to pick one of the three as being challenged, I think I'd pick Costco as being challenged, but over to the two of you for that assessment.
It really is a great business, but just on valuation, I see it being challenged, right? You don't have a margin of safety when you're buying it. A retailer at 47 times earnings.
Yeah. And maybe I don't know enough about where they're expanding, but where can they grow their market? Walmart saturated the country and then started opening those Walmart marketplace, the smaller format stores. I don't think Costco is going to end up doing that, but yeah, where does growth come from them?
Right. They could try to encroach on Walmart and Amazon and offer similar type services, but longer tail products, stuff that's not offered in the stores, but it's not going to be hugely profitable for them.
It'd be almost like a startup. Before we merge on the healthcare, because we've got to do that, we only have under 10 minutes left. If we look at page 1, this is an interesting way to look at these companies that Mike and Jason are pointing to. Amazon, of course, is number one in services, cloud services, providing server capacity to third parties. And Microsoft is number 2. I forget exactly the ratio of one to the other, but I think Amazon is still 50% larger in terms of that business. Amazon Web Services is compared to Azure. Each of them on an EV basis, look on page 1, is around, Microsoft's around 3 trillion, and as Mike said, Amazon's about 2.8. What part of the 3 trillion do you think is Azure? A third or something like that? And then would you reason from that it's say percent of Amazon is AWS?
I think that you have to assume that on Amazon's side, it's probably at least 2/3 AWS. I don't think they get as much credit for the retail business as they probably should.
So if it was 1.5 trillion out of 2.7, that would be 1.2 for everything else in Amazon. And there is, well, I think those numbers structure about right, because you have Walmart at about 1 trillion enterprise value. We'll revisit this at some point. We'll say, remember a couple of Wednesdays ago when Mike and Jason Hunt started to put these things together. We may come back in a week or two with kind of...
We could do a hyperscaler episode and just look at the hyperscale businesses of Amazon, Microsoft, Google.
Yeah, there you go. Next week.
Because there are differentiators among those.
Yeah,
so.
and we'll go all the way down to Oracle, which is in a bit of distress. I'm not sure we have room for news in healthcare. I guess the only news that we probably should mention is the Wall Street Journal article about OpenAI not meeting its budget, which caused distress in SoftBank and Oracle and Advanced Micro. Anything more, Mike or Jason, on?
Well, those numbers were end of 2025 goals. So
right.
That's 4-month-old data that really affected the market, on, what was it, April 28th of this year.
Right.
So, and they reiterated when they did interviews discussing that the other day, that the spending is going to continue. And I don't think, as long as they have the money, I don't think we should expect that. Yeah.
Healthcare, Jason. Otherwise, we'll be in the doghouse. We're now 4 minutes over, so we gotta do a few minutes on healthcare.
Deal. So going quick, the White House set out to negotiate most favored nations contracts with. They selected the top 17 pharma companies. Regeneron finalized their contract. They were the last one to do so. So the White House met their goal around most favored nations contract negotiations. We'll see if that affects drug pricing, but I believe one of the negotiation points with every company was to have a set of drugs appear on Trump RX. So we'll see if that occurs. The FDA has begun discussing modernizing the review process and that they will look at study results in real time. I think it's great that we're talking about this, but I think there's a lot of questions that need to be ironed out on how functionally that happens. So as investigators are collecting data for a clinical trial and putting it into an online system, the FDA could have access to it, but this whole process in many trials is blinded, where no one knows if you've got the placebo or the study drug, and how, that's just one of the points, but how's the FDA going to figure that out before all the data is unblinded?
Palantir.
Yeah.
Probably.
And then M&A continues. Lilly is on a shopping spree. It'll be interesting to see if all these purchases work out in the future. They're cash flush, and hopefully they're making smart purchase decisions. One of the other acquisitions that was interesting is from Teva Pharmaceuticals. They acquired a biotech. It's mostly a generics manufacturer. They do have a couple branded drugs, but what was interesting about this one is the biotech has submitted for FDA approval of a drug, but they have no approved drugs today. So maybe a little bit of a shift in Teva's strategy. I think they've signaled this shift, but this is definitely a little different take, where they're going to buy a biotech without a product in market yet. So overall, I'm pretty constructive on generics manufacturers, because we've talked about the problem that big pharma has where they have a bunch of patent cliffs. The winner of that is the generics manufacturers that now will have access to a lot of really effective drugs that they can start selling. So I don't know. It'll be interesting to see how this evolves with Teva. They're in a good position being a generics manufacturer today, but are they going to maybe abandon or deviate from that strategy at maybe one of the best times to be a generics manufacturer? So we'll see there. We'll watch it.
In terms of coming attractions, I think doing the hyperscalers next really makes sense. Also, pick up on Anthropic, which is still a private company, how they seem to have stolen a march on OpenAI. And the other thing is, we talked defense for the first time that I can remember in the 250 episodes or so we've done of the podcast. We have Palantir here. I'm going to do my best to come up with another company to add, a drone company, for all the reasons that Jason outlined. And given the fact that that's what's given the Iranians all this leverage, those $30,000 drones, swarms of them will overcome, one of our destroyers. So we keep the destroyers way offshore. The other thing we're going to do, and this weekend, on the MasterCard page is Circle, which is kind of a blockchain currency. So we've been talking about threats to franchises, and that would be a threat to the credit card companies. And sorry for running over so much, but we'll do better next week. And in the meantime, everyone be well and stay healthy. And we'll be back here exactly 7 days from now. Thanks very much for listening. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information, and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.